Welcome to the WTR Small-Cap Spotlight Flashcast. I'm your host, Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. In today's episode, I'm being joined by my colleague and WTR Senior Energy and Sustainability Analyst, Peter Gastreich, to discuss his initiation of coverage report on Green Plains, NASDAQ ticker symbol GPRE. Green Plains is an ethanol biorefining company with a growth strategy in ethanol carbon capture and storage, or CCS. On today's call, Peter will be framing the broader market for low-carbon ethanol and how it relates to the high-growth sustainable aviation fuel market, also known as SAF. Good morning, Peter, and thanks for joining today.
Good morning, Tim. Looking forward to our conversation today.
Peter, could you give a bird's-eye view of the Green Plains operations and strategy, please?
Sure, Tim. Well, Green Plains is a biorefining company that has been undergoing a transition from a commodity processing business into a value-added agricultural company. At its core, you have the production of ethanol, which is made mostly from corn. Most of us will be very familiar with ethanol as the renewable fuel and commodity product that, due to blending mandates, makes up around 10% of the gasoline that we use to fill up our cars. Green Plains is a large producer with 9 ethanol refineries now operating across the Midwest, and with approximately 800 million gallons per year of capacity. With the production of ethanol from corn, you also get a lot of co-products, including things like distillers grains, protein, and corn oil, all of which this company produces. CO2, which historically was considered as a waste stream, has now become extremely valuable to ethanol producers, mostly because of tax credits. And Green Plains produces around 2.4 million tons of CO2 annually. To capture value from those CO2 emissions, Green Plains has a strategy to capture and sequester the CO2 production at its biorefineries starting in the second half of this year, and this will result in a significant transformation of the company's operations.
Okay, that's a great introduction and good jumping off point. Could you please share some thoughts about the broader ethanol market in the US and globally? And as you mentioned, we are already at the mandated 10% blending rate for ethanol in the US. So what can drive further growth in the ethanol demand?
Yeah, that's a good question. So, given that almost all the ethanol production is blended into the gasoline pool, of course, that means that gasoline demand itself is the obvious first place to look in terms of demand drivers for ethanol. Gasoline demand has not recovered to the pre-COVID levels, and it will continue to face some uncertainty going forward with the ongoing adoption of electric vehicles and hybrid. So this leaves 2 major areas that could potentially drive demand growth going forward. The first would be ethanol blending mandates with gasoline, and the second is the extent to which demand from airline decarbonization strategies are set to drive demand for sustainable aviation fuel, which in turn is expected to drive long-term demand for low-carbon ethanol as a feedstock. Now, first, let's start with the blending mandates. So in the US, the 10% rate, or E10, has not changed in more than a decade, and this is why US ethanol production struggles to exceed 16 billion gallons. However, there is some room for optimism both in the US and overseas. For example, the EPA recently announced the implementation of E15 across 7 states in the Midwest. This could build positive momentum if rolled out to the rest of the country, but it would take several years if that happens. We can also look overseas for mandates in places like Canada and Japan. Japan, for example, looks very interesting, given that they plan to achieve a 20% blend rate by 2040, and that could be a good opportunity for US ethanol producers to export into that market. The second area, which has the largest potential to drive ethanol demand, is as a feedstock for sustainable aviation fuel. We published a lot of research on this at Water Tower Research. However, for ethanol to qualify as a feedstock, it needs to be decarbonized, and this is where carbon capture can play a role for low-carbon ethanol.
That's really interesting. Let's expand on the carbon capture strategy at Green Plains. The demand side of the equation you framed makes perfect sense to me, but can you talk about economics and how Green Plains intends to turn this into a profitable strategy?
Yes, absolutely. So there's 3 factors that I would mention here. The first one is that CCS will allow Green Plains to monetize CO2 emissions. So CO2 is no longer considered a waste stream. Capturing and sequestering carbon can generate value, as I mentioned, through the tax credits like 45Z and 45Q. The 45Q carbon credit is particularly durable given that that is a 12-year program. Second, and this is interesting from a cost perspective, ethanol CCS is favorable versus other CCS applications due to the high purity of CO2 emissions. The capture costs range from $20 to $35 per ton, which is attractive relative to the value of the tax credits. Third, by lowering the carbon intensity of ethanol and its related products like protein and sugar, the products become more attractive to customers, which are aiming to execute on their own decarbonization strategies. The SAF producers I just discussed are a prime example there.
Are you able to illustrate the financial impact of Green Plains from this CCS rather?
Well, starting from the second half of this year, Green Plains will be capturing CO2 from its 3 biorefineries in Nebraska, which is roughly 1/3 of their total capacity, while a company called Tallgrass Energy is going to be transporting the CO2 via pipeline to a permanent sequestration site in Wyoming. Management expects to generate $130 million annually with the help of the tax credits. So for a company that delivered just $19 million in EBITDA last year, you can see how this is going to be a substantial contribution ahead.
Speaking of EBITDA, I think maybe I'd like to pivot and just ask your thoughts on the company's financial condition.
So the last few years have been pretty challenging for Green Plains. The company has been deploying capital into growth initiatives at a time when the core ethanol business has been suffering from weak margins. So Green Plains has endured several successive years of negative free cash flow, and the balance sheet has seen some deterioration as a result. This has been among the factors leading the company to announce restructuring and cost-cutting initiative recently. So for management, so far they have identified about $50 million in annualized cost savings. Still, even after the cost cuts, with the ethanol market looking challenging at the start of this year, Green Plains cash flows would likely be under pressure at least up to that point when the CCS initiative starts to generate earnings and support cash flows starting in the second half of this year. But combined, the $50 million in annualized cost savings and the $130 million benefits from the CCS strategy are leading to consensus expectations for significant earnings growth through to 2027.
If I throw on my old analyst hat, Peter, it sounds like there's a major inflection point coming down the road. So we can't talk about biofuels and carbon capture without asking about the policy environment. I would be interested in your views here as well.
Yeah, thanks, Tim. Yeah, very topical question right now. But overall, there has been a lot of bipartisan support in Washington for homegrown biofuels as being beneficial for the rural economy and energy security. In this sense, CCS is a path to enabling growth in the rural economy. This is because it would position the U.S. as a globally competitive supplier of low-carbon ethanol and sustainable aviation fuel, which in turn supports corn growers. And Green Plains is positioning really for that sort of a future. For example, Trump's National Energy Emergency Executive Order is not focused on fossil fuels alone. It is an all-of-the-above strategy. It lists biofuels, specifically ethanol and aviation fuel, alongside natural gas liquids, oil, and other fuels. So if you take a look at Trump's Interior Minister, Administrator of the EPA, and Secretary of Agriculture, all three are very pro-biofuels. Interior Minister Doug Burgum, who is a former governor of North Dakota, by the way, is hugely supportive of CCS and the impact that that can have on the Midwest agriculture. And let's not forget tariffs. Ethanol can be vulnerable, and we need to pay attention here. Canada, for example, is the biggest market for U.S. ethanol exports, so we don't want to see ethanol fall into the crosshairs there.
Thank you, Peter Gastreich, for those insights surrounding your initiation of coverage equity research report on Green Plains, NASDAQ ticker symbol GPRE. A special thanks to the producer and editor of the podcast as well, my colleague, Joe Brunetto. Thank you for listening, and don't forget to subscribe, as well as visiting www.watertowerresearch.com to read the Green Plains report, if I can speak properly, as well as to access countless other small cap equity research reports, podcasts, fireside chats, and conference schedules from Water Tower Research. We will see you next time for another edition of the WTR Small Cap Spotlight Podcast.